Hello everyone and welcome back. My name is Greg Furman, market analyst here at TraderPlanet.com, and this is the Forex weekly outlook for the week of November the 28th, 2011. Now, to get started here, we're going to begin where we always do with the US dollar index, still looking bullish here. Some resistance up around this 80 level. If we can push over the 81.37 level, we should see the dollar continue to extend higher, but we are getting a little bit overbought on the predicted TSI. Predicted MACD has room to extend. Predicted short, medium, and long-term differences also have room to extend. So the bias remains in the Forex market. We're either buying or selling US dollars. That's what Forex is. Our primary goal here is to buy dollars and look for places to do that. So now, if we can't overcome this 81.37 level, then we're probably going to see a corrective move lower in the dollar. But I don't think that's going to be for a few days yet. I think that again, what I've said over the last several weeks is that the issues in the Eurozone are just getting started. And what I've also talked about, or what I'll talk about now, is that usually these things follow a pattern. The banking crisis, the recession, everything that's happening, it starts in the U.S., it usually then moves into Europe, but then it usually moves into your emerging markets. So this is something we don't want to overlook. And it could have a very interesting effect on certain commodities, which I'll touch on in a minute. But for now, we remain dollar bulls. Key levels 78.11, 78.68, and 79.20. Now, going into the S&P 500, I've also talked about any move higher, and this should be shorted. Again, we've moved aggressively lower after a much lower high. We've come back down to the vantage point. Key levels, you can see that this has been this 18-day predicted moving average has been tagged multiple times, and then you get your break. The markets do not just go straight up and straight down. They bounce around, they move up and down, but there is a pattern. You can determine whether it's bullish or whether it's bearish by these types of moves. So we can see that it's come down, hit that level, bounced higher, but eventually, like I was saying a week or two ago, the bigger play is going to be to the downside. Now, again, we're pushing it here on the vantage point. Predicted medium and long-term differences. We are grossly oversold. I expect a bounce, but I don't expect a significant bounce. Key level 12.11, 11.92, 11.67. 11.92 is the area that I would probably target this week, that we would see a retracement to, then an aggressive sell-off right afterwards. Coming into light sweet crude oil, I've told my guys in the webinars this week, we're only selling crude oil. I've seen some other analysts looking at buying crude oil off the 95 level. It's a play, but a very dangerous one. And again, this is the problem with doing single market analysis, looking at a single chart, not comparing it to anything else, is what you'll find is that you'll be missing something. Now, when we look closer at the light sweet crude oil and we compare it to the equity markets were actually a leading indicator that crude oil was going to move lower. Now, you've got this base around what we could talk about potentially is what I've seen is ranges between 103 and 95. Well, to be perfectly honest, guys, there is no range here. These two candles represent they represent noise. Lower inventories, I believe, in oil, so it gets a little short-term boost higher. But the bottom line is, when you have countries going into recession, crude oil is moving lower. It's not moving higher. Any attempts to buy this market down in here, very, very dangerous. And of course, I've made the recommendation for weeks to any rally towards 100, sell it. Terrific selling opportunity. I would be looking for crude oil back down in this 85 level or even lower. So waiting to sell it at a break of 95 or a break of 90, no, get your shorts in now. This trade is it's setting up quite nicely. Now, again, what I'm going to show you here is when you take the correlation to another market and move away from single market analysis. Now, when I split the screens and I put the light sweet crude oil down on the bottom here and we look at the S&P 500, we can see that we've had a sell-off on the S&P 500 basically back over a week ago that this has actually started. So if I actually take the medium-term crossover from Vantage Point and we hit applied all, and then we look at this, we can actually see as the light sweet crude oil moves up, so do the equities. But then as the equities start getting into trouble, they actually start to fall. Crude oil starts to flatten out. Then all of a sudden we have the S&P 500 breaking significantly lower. This is a leading indicator that a much bigger move in light sweet crude oil is coming. This is the advantage of doing intermarket analysis in real time. We know what's going to happen. Now when we take this one step further, should we be selling natural gas contracts? Of course not, because you can see the correlation as natural gas goes down, crude oil goes up. Now supply may be high in natural gas, but the bottom line is it's still a commodity that is going to be in demand, if not now, in the very near future. So when we look at these correlations, you can see as light sweet crude oil starts to drop lower, we're developing a very strong buy signal on the natural gas UNG. This is a decent contract to trade. Now natural gas has been quite bearish. I think this move is grossly overdone. Do I want to sell rallies? Of course not. We would look at buying dips. The harder oil falls,